In the Black Out Loud.
Tax and charity giving. Is it time for an overhaul? Tax deductions for the wealthy have been bolstering philanthropic funds for some time now. The challenge remains to make the mainstream population feel their contributions count too. By Prue Moodie. This article has been edited for audio purposes. Article begins. The fusion of tax breaks and philanthropy has given rise to what seems like an embarrassment of donations, both globally and in Australia. Yet the need for charity still nearly always outstrips supply. On the surface, a high level of donations would seem to be the mark of a kind and responsible society. Nurturing a community of givers is the usual government rationale for providing tax advantages to donors. Back in 2022, before the Australian federal election, the Labor Party promised to double donations by 2030, thereby building a reconnected Australia. According to the 10th edition of the Australian Charities Report, in that reporting period, Australia's charitable donations reached around 13.9 billion Australian dollars, including non-tax deductible donations. That's respectable growth from approximately 9.9 billion Australian dollars in 2017. But it might not tell the whole story. The proportion of Australians making tax-deductible donations is trending down, which could mean either that less donations are being made or less people are claiming the deduction. Moreover, almost half of Australia's tax-deductible donations come from people in the top 1% of income earners. Similar trends have been observed in the US and UK, according to the Australian Government Productivity Commission report Future Foundations for Giving, released in May 2024. Policy options. The giving gap poses a challenge to government philanthropic strategy. Policy settings could aim to increase the levels of donations, as Labor pledged in 2022, and as Singapore appears to be doing. Alternatively, Australia's philanthropic strategy could be designed to encourage altruism without placing excessive strain on the public purse. Annually, tax deductions for gifts and donations from individuals and corporations, including donations made to ancillary funds, cost the public purse about 2.2 billion Australian dollars, according to Treasury estimates. Presiding Commissioner of the Future Foundations for Giving report, Alex Robson, says doubling donations by 2030 wasn't a target of the Productivity Commission report. He says, "You'd probably get to a doubling with no policy change. We didn't take a view on that." Instead, the report's recommendations focus on the tricky balancing act of removing friction from the system to encourage giving, while doing as little damage as possible to public finances. Examine tax deductibility. Alex Robson characterises Australia's tax deductions for philanthropy as already generous, given an international comparison. He says in Australia, you could claim $1 billion against your taxable income if you give to a charity with deductible gift recipient status, whereas in many other jurisdictions, it's not like that. If you look at the US, for example, there are various kinds of restrictions on the amount that you can claim. Even in Singapore, with its 250% tax deductions, the tax impact may not be as beneficial to the donor as it is in Australia, because of Singapore's lower tax rates of 24% or less. Also, Singapore has a narrower range of charities that qualify for tax-deductible status, implying a higher degree of control over donors' choices. Illustrating the delicate fiscal trade-off between giving and tax deductibility, Ram Subramanian, financial reporting lead at CPA Australia, points out that Australian government funding provides more than half of charity revenue, and that all philanthropic financial donations, not just tax-deductible donations, provide only 6.9%. Subramanian says, this reflects the fact that the Australian not-for-profit sector provides many services such as healthcare and education on behalf of government and relies on government funding to provide such services. The Productivity Commission report did not recommend increasing the tax deductibility of donations. Alex Robson says that price elasticity modelling suggests that for a small change in tax deductibility, you get an extra donation, but that's exactly offset by a reduction in government revenue, so society as a whole is no better off or worse off. Reforms to DGR and ancillary funds. Instead of raising tax deductibility, one of the Productivity Commission's most powerful recommendations was reform to the deductible gift recipient (DGR) system, which defines which charities are eligible to provide a tax deduction. There are about 25,000 entities with DGR status, but the report describes the DGR system as not fit for purpose. Alex Robson says, the DGR should be as broad as possible to cover as many entities as possible. The report noted that applying for DGR status should be fair, simple and transparent. It should direct donations towards charitable activities that are likely to provide the greatest net benefits to the whole community. Robson says that if the government decides to reform DGR as recommended, more charities would gain DGR status. He says, applying some of the estimates, we find a modest increase in overall giving. But again, there are trade-offs. For example, the Productivity Commission report recommends removing tax deductions for school building funds from DGR status. It noted that the transaction here is closer to a market exchange of donations for lower fees. The Labor government ruled out this particular recommendation prior to the May 2025 election. The philanthropic system is vast, and unintended consequences from every change ripple through the system. The job of the Productivity Commission is to try to anticipate as many of these consequences as possible. Another recommendation was to raise the annual minimum distribution rates of public and private ancillary funds to between 5% and 8% of net assets, from the current 4% and 5% respectively. Ancillary funds are special purpose donation vehicles that allow an immediate tax deduction, even if distributions to charities are spread over a number of years. CPA Australia and Chartered Accountants ANZ's joint submission to the draft version of the Productivity Commission report cautioned that mandatory minimum drawdowns have the potential to threaten the liquidity of funds which are set up for longer terms, particularly ones intended to run in perpetuity. A charity speaks out. Angela Taylor, FCPA, CFO of Victoria-based DGR charity, Asylum Seeker Resource Centre, supports a higher contribution rate from ancillary funds. Taylor says, one of the findings of the report, lifting the annual percentage of giving for those ancillary funds, resonates with me. That sounds like a very logical conclusion, because it would give more immediate access to funding for not-for-profits. Taylor values the contribution that ancillary funds make. In her experience, they bring greater reliability to funding than relying predominantly on public fundraising each year. She says, what motivates our donors is that asylum seekers and people seeking refuge have human rights, and those human rights need to be upheld. The role of accountants. Accountants have an important role as the donations mount. While they have always advised donors on structuring their donations, Ram Subramanian thinks that, in the case of large donations, accountants could also work with the accountant from the recipient charity. He says, they can ensure there are procedures and policies in place for the donation to be applied to its intended purpose. Sometimes there's a lag between the receipt of the funds and use of the funds. The accountant can advise on prudent investment and management of money until it's needed. In the case of a donation made for capital purposes, for example, the construction of a building, the accountant can assist in project managing the funds over the period of capital expenditure. All giving matters. Before the era of tax deductions, giving to charity was primarily an act of conscience, an expectation of acquiring merit, or an expression of kindness. Low and middle-income Australians may well meet this definition more than the tax deductibility data shows. Philanthropy Australia's Greater Giving Report estimates that about a quarter of donations to charity are not claimed against tax. What's more, Australia came in at number 8 on the World Giving Index 2024, beaten by Indonesia, Kenya, Singapore, the Gambia, Nigeria, the US and Ukraine. Around 59% of the Australian sample said they donated to charity, and 34% said they had volunteered. The Australian system provides no tax incentives for volunteering, and the Productivity Commission report made no explicit recommendations. One of the downsides to the dominance of the donor class is that its emergence could lessen the motivation of others to give. The Productivity Commission report highlights the difficult government policy choices that will help ensure the system builds a stronger community.
In the Black Out Loud.